Hi there, welcome to Neppy Invest. So today we'll look at three small cap ASX companies that all released a bullish announcement on Monday the 14th of December. And I'm just going to discuss these companies, look at those announcements, and then look at their financials and the charts and sort of discuss or figure out whether these companies are a buy or potential buy, whether they're just worthy enough to be put on a watch list to maybe look at further, explore further in the future, or just give a flat out no to, I don't really care about these businesses at all. So to give it away, one of these companies I'm going to give that flat out no to. Another company I'm going to put on my watch list because there is potential for future excitement in the future. And another company I actually do like and is a potential buy. So let's get stuck into it. And the first company I'm going to look at is Cellnet. Now, Cellnet, I started following this company in 2018 because they had some good announcements that year. So I put them on my watch list, but then they really disappointed in 2019. So they've been listed on the ASX since 1999, yet the market cap is 17 million. Now, that's the first red flag that just triggered in my mind as soon as I saw that. They've been listed for 21 years, yet the market cap is only 17 million. So there's something going wrong with this business. It's just not working. You're not seeing any growth in the market cap. So they're a distributor of lifestyle technology products, and that's also a bit of a red flag there. That's probably suggesting that there's going to be low margins in this sort of business. Now, they did give a November trading update, which was quite good. So in isolation, if I saw this announcement in isolation, this trading update, I would have went, oh, this is quite impressive, and I have to explore this company further, which I did just for the purposes of just doing a little bit of research. So their November revenue up to 27% year on year, net profit up before tax up 174% year on year, although that's from a small base because they're only up to 1.2 million. And year to date, net profit before tax up to 2.8 million. And they've also mentioned that the retail momentum has continued because of iPhone 12 and console gaming accessories. So in isolation, that's a pretty good announcement. But when you look at 15 years of financials, which I've got right here, many red flags, many reasons to say no about this company. And it all comes back to the fact that they've been listed on the ASX since 1999 or 21 years, and the market cap is only 17 billion. Yeah, so no growth. So what I want to see is profit operating cash flow increase year on year. And can you see that here? No. So you can see actually they do have some good years, but those good years are in between bad years. And we definitely saw that in 2018. So 2018 was their one good year, had profit and operating cash flow of 6 million. So the market did get a little bit excited. That's when I put it on my watch list. And then they really disappointed in 2019. So even though revenue went up from 87 million to 111 million, profit and operating cash flow went backwards. So just the fact that you can see pretty high revenues there, 110 million, but no profit, which suggests very low margins, and gross margins 18.9% or 18.8% in 2020. That's really low for gross margins. That's sort of numbers I'm not really interested in. So overall, this is a flat out no to just based off these numbers. Not interested at all. And the chart tells the same story. This has been an absolute disaster for any shareholders who bought in the IPO and have just held long term. It's been a sort of a wealth destroyer for those shareholders. The share price was high as 70 cents just after the IPO in 2000, and now we've seen it get down to as low as 4 cents and right now 8 cents. So it has been not a very good company to be holding. In fact, the share price chart is doing the complete opposite to what you want as a shareholder. It's going from the top left to the bottom right. What you want to see is a share price chart going from the bottom left to the top right. Probably the only positive thing I can find in this chart is the fact that the volume has exploded in the past 2 months. And that is a slight positive that may be suggesting the market sees something in this company. But that's also a possibility that the market in itself is very over-exuberant. We're seeing retail investors get into small cap companies and get very excited about announcements like this, overexcited. And a lot of these retail investors probably haven't looked at the history of Cellnet. They've just seen this trading update and went, oh, what's a buy? So flat out no for me. The only way this becomes a possibility where I might put on my watch list is we see continued growth in 2021. But there is a possibility we might see this company disappoint next year. And that's just based off the fact that we've seen a lot of retail companies have a good year this year just because of stimulus. People are spending a little bit more because of stimulus. And once stimulus dries up and spending dries up a little bit, we might see a lot of retail companies disappoint in the calendar year 2021. So no, Cellnet, I'm sorry, you are definitely not going to be put into my portfolio. Will Beam Communications be put into my portfolio? Well, no. And I'll discuss why. So this company does have a markup of 24 million. So they design, develop, manufacture, and distribute satellites, or sort of satellite phones, that sort of thing. Now, they did release a new product at the start of this year. And the only reason I'm really following this company is because of this new product. I want to see how much traction it's getting, or it gets, and because I think the future of this company is going to be highly correlated to the success of this Zoleo unit or product. And it is starting to gain traction in Australia and North America. You can see they're selling quite a few, or their orders are up to 34,500 units. And they're expected to agree to some more agreements to major retailers in early 2021. So there's a little bit of excitement to this company based off this new product, Zoleo. So I just want to see how this product does, how their financials do. And when I look at their financials, I'm not going to look at that Appendix 4C going back to 2013. What I want to see in sort of this sort of chart here is, again, the cash receipts going up through time. So this is cash receipts from the Appendix 4C. Cash receipts going up through time, and then if they're going up through time, that's when I start to explore the company in greater depth. And this company is not doing that. It's just a flat line, sort of choppy, lumpy sort of revenue. In fact, their highest cash receipts going back to July 2013 were in July 2013, and that's the only quarter they've seen cash receipts above 5 million. So in the previous quarter, they had cash receipts of 4.1 and were slightly cash flow positive in operations to 152,000. More than likely, they were free cash flow negative, just because if you take into account capital expenditure, financing, that sort of thing, they more than likely were cash or free cash flow negative. So if I was just looking at this in isolation, this would be a flat out no. But I haven't taken into account what this new product Zoleo is going to do for the cash receipts. If I start seeing cash receipts starting to trend up quarter on quarter, that's when I might become interested in this company for the long term. Otherwise, it's going to be put onto my watch list. It's already on my watch list, but it's going to be put onto my watch list for future exploration, to look for future announcements for increasing cash flow, that sort of thing, increasing cash receipts, increasing orders of Zoleo. So just looking for some more bullish announcements in the future. And then I want some proof that the financials are increasing. Probably the one little interesting thing is when I look at the chart here, we can see a really good level of resistance at 35 cents. So it's hit 35 cents 4 times in the past 2 years or so. And every time it's hit 35 cents, it's bounced off it, hit it again, bounced off, hit it again, bounced off. So this time might be a little bit different. So on the release of this announcement, the share price went up to around almost 40 cents, and then there was a lot of selling, and the share price pulled back towards that price of resistance. And then yesterday, the 15th of December, it then pulled back to around 32 cents. So a lot of selling, pushing that share price below that price of resistance. And a fair bit of volumes coming into this too. So the market is starting to take notice of Beam Communications, and that could be a bit of a bull signal too. If the share price gets above 35 cents and stays there, we could see the signs of the start of an uptrend moving forward, which would be, if you're a trader, a good time to buy in. So the last company I'm looking at is EnergyOne. This has a market cap of 134 million. And so by the process of elimination, I've given it away here. This is the company I'm excited about. So they are a software system provider or supplier for the energy trading and risk management sector. So they are a SaaS company. And if you know anything about me, I do like SaaS companies, but I particularly like SaaS companies that are profitable and cash flow positive. EnergyOne is that. So let's get into it. So their announcement is actually also my favorite sort of announcement. It's profit increase to guidance. So profit increase to guidance. The only thing I didn't like about this is they have different periods. So they gave guidance, or the previous guidance was for the full year for financial year 2021, which was revenue 25 million, EBITDA of 6.5 million. But their updated guidance was only for the half year, and that was to 13.7 million and EBITDA of 4.1 million. Now, they did mention later in the announcement that this company's services or revenue is neither seasonal nor symmetrical. So no, it's not appropriate to assume that the half-year results will be replicated in the second half. So a lot of people would just look at those half-year numbers, just times it by 2 and think, oh, wow, that's pretty good. And actually, in fact, I did that. I went to EBITDA 4.1. If you times that by 2, you get 8.2 million for the full year. So they're just saying, warning people, don't do that. But so that's the one thing I don't really like is the fact that their previous guidance was the full year and the updating guidance wasn't for the full year, it was only for the half year. So that's one little negative thing about this announcement, but it's a sort of announcement I really, really like, and usually the market really, really likes it too. So what I've done now with their financials is look at the revenue market cap here. So going back to 2015, looking at 7 years of number. So the market cap here is, I just divided by 10. So this is times these numbers in market cap by 10 million, you get a true number. So if you go back to 2015, they had a market cap of 6 million, revenue of 5 million. So that's a very small company. And you can see the hit or inflection point in 2017 when the market cap went from 8 million to 18 million, then it went up to 35 million in 2019, 99 million in 2020, and currently it's 134 million. So we're starting to see traction in the market cap, and that's following the increases in revenue. So revenue has gone from 4.8 million to 20.3 million in 2020. So starting to see exponential increase in revenue, and we're starting to see the market cap or share price following that. That's exactly what I want to see in a company, this sort of increase in revenue and share price or market cap. So next thing I looked at was the profit, operating cash flow, and share price, and we definitely see the sort of chart you want to see here, sort of an exponential increase in all three, all three. So operating cash flow has gone from 1.4 million and is now at 5.1 million, and share price has gone from 33 cents to $3.9 on August 2020. Currently it's over $5, so since 2020 it's really increased, and profits have increased, not a lot, but only from 700,000 to 1.7 million. But I think we're going to see profits increase quite a bit moving forward, just based off operating cash flows increasing a lot too. So exciting company, EnergyOne, and we've really seen the share price really take off, volume increasing too, which is another bullish thing. So the best time to buy this company was in 2017, when they probably gave up some really positive announcement, and the share prices just kept on going up. Even in the downturn, really good buying in the bottom of the the COVID-19 financial panic, when the share price got down to about $1.50. I still remember thinking, oh, this would be a good time to buy EnergyOne, and it was definitely, but I was too late. And anyway, yeah, so excited about this company. All-time highs, the share price. So when I did this video, or prepared this video, the share price was $5.19. I looked at share price at close on Wednesday, 16th of December, and share price is about $5.48. So we saw some good price action today on the share market. So are these three small cap ASX companies a buy? So with Cellnet, that's definitely a no. I'm not even interested in that company. Beam Communications, I'm going to put that on my watch list because it has potential. We might see some good financial increases in their profit, operating cash flow, and revenue if their new product Zolio becomes really popular throughout the world. And then EnergyOne, profitable, positive operating cash flow for a SaaS company, only 135 million or 140 million market cap, growing quite strongly. So the only thing I'm concerned maybe is the market, the potential market is maybe quite low. And the other thing I'm concerned was just the announcement was a bit weird, how they suggested that was an increase in guidance looking at different periods. Anyway, if you have any comments on these companies, maybe you're a big fan of Cellnet and you think I'm an idiot for saying no, or maybe you're an EnergyOne buyer. Well, the other thing I'm actually a bit wary about EnergyOne is they have low liquidity. So I just looked at the action today. There wasn't a lot of trades, only like 5 or 6 trades today. So low liquidity, but that could mean once the company starts to increase their profits, operating cash flow, you start to see managed funds getting interested and more trades happening on a day-to-day basis. And that's how you see share price growth through time. So anyway, I'm not a financial advisor, so if you need financial advice for your own circumstances, make sure you seek out someone who is qualified. Otherwise, that's all for today's video. Have a good day and speak to you soon. Bye.